You don't need a PhD in finance or economics to beat Wall Street at its own game. Forget the complex algorithms and insider jargon. All it takes is a little common sense and a willingness to do some basic homework. The pros, caught up in their models and metrics, often forget that a stock represents a real, tangible piece of a real business, not just a fluctuating ticker symbol on a screen. It's about ownership in something concrete. If the underlying business thrives and grows, generating profits and expanding its reach, so too will your investment. And here's your edge. You encounter great companies and potential investments every single day, often without even realizing it. You see them at the store, the places you frequent and enjoy. You interact with them at work, observing their operations and strategies. They're all around you, woven into the fabric of your daily life. But simply noticing a busy store or a popular product isn't enough to warrant an investment. You need to delve a little deeper and check if the numbers ultimately back up your initial intuitive hunch. Think of reading a company's financials like carefully checking under the hood before committing to buying a used car. The numbers will reveal whether a company is a smoothly running, well-oiled machine built for long-term success, or if it's a potential financial disaster just waiting to happen, masked by superficial appearances. Don't be intimidated. You certainly don't need to master every single financial detail. Just learn to spot and understand a few key indicators that signal a company's overall health and potential. The initial story and the company's narrative might get you interested and excited, but ultimately, the numbers are what will keep you confidently invested for the long haul. Annual reports can often look intimidating, a daunting stack of papers filled with complex jargon and numbers. They might seem overwhelming at first glance, but don't be discouraged. The key is to focus on the three main financial statements that provide a clear picture of a company's financial health. These are the core documents you need to understand. The balance sheet is like a snapshot in time, showing what a company owns, which are its assets, and what it owes to others, its liabilities. It's a fundamental report. Assets, which are resources like cash, equipment, and inventory. Liabilities, which are obligations like loans and accounts payable. And what's left over after liabilities are subtracted from assets, which represents the shareholder's equity or the company's net worth. The income statement, also known as the profit and loss statement, reveals if the company is actually making money over a specific period, like a quarter or a year. It starts with revenue at the top, the total amount of money the company brought in from sales, and ends with the bottom line, the net profit, which is what's left after all expenses have been deducted. The cash flow statement, often overlooked, tracks the real cash moving in and out of the company, providing insights into how the company generates and uses its cash. This statement is crucial for showing if the business has enough liquidity to pay its bills and meet its short-term obligations. Cash from operations is key. It's the lifeblood of any business. A healthy company generates plenty of cash from its core business activities, indicating sustainable profitability and financial stability. To get the full picture of a company's financial health, it's essential to look at all three statements together, analyzing how they interrelate. Big profits on the income statement mean little if debt is piling up on the balance sheet, creating a precarious financial situation. Or if cash is rapidly running out, as indicated by the cash flow statement, signaling potential trouble ahead. It only takes a few minutes to check these basics and get a sense of a company's financial standing. Don't skip this crucial step. It's a fundamental part of responsible investing. It's your best defense against making bad investments and potentially losing your hard-earned money. Master these fundamental concepts, and you'll be ahead of most investors, equipped with the knowledge to make informed decisions. What should you look for first? Growth. Check the income statement. Is revenue rising year after year? Consistent sales growth, 20% or more, is a great sign. But profits matter too. Are they growing as fast as sales? If profits lag, costs may be out of control. If profits outpace sales, that's efficiency. Check the balance sheet. Is debt manageable? More cash than debt is ideal. Your checklist. Rising sales, rising profits, healthy balance sheet. Find all three, and you've likely found a winner. It's not rocket science, just common sense and discipline. Numbers show the past, but clues to the future are in the annual report too. Look for a growing order backlog. Strong demand means future sales. Big new contracts or investments signal management's confidence. The MD&A section reveals what leaders are planning next. Strategic moves, new products, new markets can be game changers. Combine hard numbers with these clues to build your investment case. A company with solid growth and big new deals could be just getting started. That's how you spot tomorrow's winners today. So, you're eyeing a stock, but what's a fair price? What should you realistically pay for it? A quick and insightful method is to use the price-to-earnings PE ratio. It's a fundamental tool in any investor's arsenal. The PE ratio essentially tells you how much you're paying for each dollar of profit the company generates. It's a direct comparison of price relative to earnings. Remember, fast-growing companies, those with significant expansion potential, generally deserve higher PEs than companies with slower growth. As a rule of thumb, a PE ratio that's close to the company's growth rate can often be considered fair, indicating a balanced valuation. For example, if a company's earnings are growing at a rate of 25% annually, and its PE ratio is around 24, that suggests a potentially reasonable valuation, aligning its price with its growth. Always connect the stock's price to its actual performance and future potential. Don't overpay based solely on market hype or fleeting trends. To get a feel for this, practice. Pick a company that interests you. Carefully check its historical and projected growth rates. Examine its debt levels, as high debt can impact future growth, and analyze its current PE ratio in relation to its growth and industry peers. Remember, the more you practice this valuation method, the more intuitive it will become, and the better you'll get at identifying undervalued opportunities. This quick 5-minute checkup is a powerful tool that helps you avoid potential investment duds and costly mistakes. Ultimately, it increases your chances of finding those hidden winners that can significantly boost your portfolio. It's a simple, yet powerful technique, and anyone, regardless of their financial background, can easily implement it.